Hey everyone, we're going to go ahead and get started. Thank y'all for being here. This is going to be formal, informal conversation to really talk about equity and access to equity in this work that we're doing of real estate development, community development, really looking to serve underrepresented areas. And so this is coming to you from three amazing organizations. And so want to be able to highlight the partnership that has come together to really get the word out, to be able to share with you. And so we're going to start with Brandon from AAREP. Brandon, if you could share a little bit more about what y'all do and the reason for you all joining us in this conversation.
Absolutely. And thanks, Maggie and Derek. And thanks, everybody, for being on the call. Also, thank you to the speakers who are going to help inform everybody about access to equity, access to debt, and just kind of give a little highlights of how to go about seeking these resources. And, you know, the thing about an event like this, and Maggie and I and Derek had a conversation, when we get information like this that comes to us, we want to make sure that we're sharing that information to the people that need it. So the great thing about this event, it is, there's people who are new to the business, people who are established, people who have projects kicking off, and this is going to help everyone. But going into AAREP DFW, my name is Brandon Bradley. I'm the president of AAREP DFW. We've been in existence for about 2 years now. We actually just celebrated our 2-year anniversary about 2 or 3 weeks ago. AAREP DFW is an organization that focuses on all aspects of the commercial real estate space. So whether you're a developer, a broker, a property manager, anything within the corporate commercial real estate space, we focus on bringing African Americans and advocates together within our space to not only network with each other, but find opportunities to work with each other. So if you guys want any more information about AAREP DFW, feel free to follow our LinkedIn page, AAREP DFW, or send us an email at info@arepdfw.org, or just reach out to me directly. And somebody from our team will reach back out to you and discuss, how we can work together.
Awesome. Thanks, Brandon. Appreciate y'all's partnership in this work. Derek, you want to talk a little bit about BCREN?
Yeah, so BCREN is a lot like AAREP DFW in that we are trying to provide connections to opportunities. So I won't go into detail about what we do, but what I will say is that it is not an endorsement of any of the organizations represented on the call today. We are simply trying to share the information so that you have access to it. That's it.
Awesome. Thanks, Derek. We appreciate it. So let's, and let me talk a little bit about the Community Developers Roundtable. My apologies. So the Community Developers Roundtable is an initiative of Innovon Neighborhoods. It is a collaboration of developers of color who are already in the development process, already doing deals, and then helping them grow their existing capacity. And so we have a ton of resources and partnerships, and several of those CDR members are on the call. So thank y'all for joining us today. And, we're excited for the work that we're doing as well as the partnership. So what was alluded to with Brandon and Derek was a little bit more context of just kind of why we wanted to have this conversation. I think for me, what we see is that there's a desire to put capital into the Texas market, and more specifically the Dallas market. And there's often a mismatch of either what those terms are, what where developers are, where the capital, types of projects that capital wants to look into, et cetera. And so as these different funds and entities, so MSquared, Trufund, Blue Vista came and, talked to all of our organizations, one of the outcomes was that one of the outcomes, of those conversations was that let's just kind of, at least as was said, let's get the word out. So I want to say that, like, you may see some things here where you're like, I don't fit the bill for that right now. That is A-okay, right? It's really that you are more aware of the opportunities that exist, so that, we're all getting prepared for this type of capital. At the same time, it may be that this is the exact funding that you've been needing for the deal you've been working on, and you have a track record that you want to demonstrate and prove up to this team. This is a good time to network with this group of folks and just share more about what you're doing. So it's informational for sure, but also we'll have time at the end. So we're going to ask them to get through their presentations for you to ask questions, all these other things. So that's going to be our request. In the meantime, if everyone wants to introduce themselves or share your LinkedIn or anything in the chat, you're welcome to do that. It's about 50, 60 of y'all in the Zoom right now. So you're welcome to network in the chat. So let's get to just introducing our speakers. And so, Gerald, we're going to start with you. I'm going to ping you up here. If you want to do your introduction, then we'll go to Blue Vista. So Michael and Dwight, and then we'll do MSquared. So Andrea.
Right. So I'm just to clarify, I'm doing the presentation, my presentation at this
Oh,
point as
just
well.
do your quick introduction and then we'll
Okay.
do your presentation. Yeah.
All right. So my name is Jarrell Duffy. I'm a VP of Impact Investments at Trufund. I represent the IDF, which is the Impact Developers Fund.
Hi, I'm Mike Whiten with Blue Vista Capital Management. I came in about 3 years ago to focus all of my time on our accelerator fund that is focused on providing early shots with institutional equity to diverse managers or operators for that matter. And then Dwight Stevenson is on as well. If you want to introduce yourself, go ahead. All right.
Well, no, Dwight Stevenson here. I'm a principal with Blue Vista Capital Management. I've been with the firm for 6 years. The firm has been around for 20 plus years, and work alongside Mike Whiten and focus on new sponsorship relationships for all of our JV equity strategies, including our impact fund. Thanks.
And I'm Andrea Wenner. I'm the Director of Investor Relations and Strategic Partnerships at MSquared. I'm very happy to be part of the conversation today.
Awesome. Thank you. So, Jarrell, we are in your hands.
Okay, awesome. It's a very scary place to be, Maggie. So as I mentioned, my name is Jarrell Duffy. I represent Trufund and IDF. Just a quick intro on Trufund. So first, today's topics, what we're going to be discussing, just sort of a quick introduction on the company and IDF, as well as we're going to do sort of a high-level discussion of equity, specifically the kind of equity we do, which is preferred equity. And then we'll just kind of go into the product overview and then a quick case study. So Trufund has been around for, sorry, Meg, I'm trying to get to the next slide here. Trufund has been around for about 20 years. We're headquartered in New York City. We have offices in Texas and Louisiana, Alabama, as well as Georgia and Atlanta. Our core mission has always been to help Black and Brown communities, LMI communities across the country to access capital markets, to build and grow small businesses, and in my specific case, to help expand real estate companies or real estate development companies. Trufund is, as I said, in 4 states, but we also have territories outside of that we support with our New Market Tax Credit platform. The New Market Tax Credit platform is not my specific platform, but if you have a project that you think may be suitable for new markets, please give me a call or shoot me an email, and I can connect you with our Trufund representative who does that. Okay, next slide. So I represent the structured and lending and investments team in Trufund, and that represents the IDF, the Impact Developers Fund. The Impact Developers Fund was created in 2020, about 4 years ago, to basically solve a certain problem, which is the representation problem in the affordable housing space. Large projects, large RFPs, it was hard to see or to find, Black or brown developers, minority developers, women developers in the room to be able to win those deals. And so the question was, how do we solve that problem? And so collectively with Morgan Stanley and the Ford Foundation, we created the IDF, the Impact Developers Fund. And what we do is we place preferred equity into the operating companies of developers. And that tries to help solve the growth problem, right? So that preferred equity can be used for working capital. It can be used for pre-dev. It can be used for liquidity reserve. It can be used for refinancing parent level debt. And it looks like equity on the balance sheet. So it helps to unlock growth and helps to unlock access to capital markets. We did 5 investments so far. 3 of them are located in New York. One's in Charlotte, one's in Detroit. You can see them on the slide here. And those investees have proven our thesis. We invested capital within the parent company. They're able to deploy that capital to get more affordable units out the door, to win larger RFPs, and to access the capital markets, get traditional forms of debt in a more profound way. So I have good news. Actually, we just closed our second round of funding. We closed that officially today. So we just expanded our fund to so we're now doubled the size, and so we're now looking to circle new investments for that fund and deploy that capital. So this is kind of an overview of just what equity is, and there are probably some of you or many of you in the room that have this understanding, and there's probably many that don't. So I just want to kind of go through and level set. We're preferred equity, and we did this for a reason. Preferred equity is sort of like a blend between common equity and debt. So common is, you own a percentage ownership of the company. Is what you see on Shark Tank all the time. Preferred equity is not that. We're not taking a percentage ownership of the company. However, we are in a priority position to common. So we would get paid before common shareholders would get paid, but we would get paid after debt. So sort of that in between product. And so that's where we come in. We come in as preferred equity. So we look like equity on the balance sheet, not like debt, but it has certain features that help benefit you. So next slide, we'll go over those features. So with debt, it shows up on the balance sheet as a liability. And so as a banker, as you're looking at the balance sheet of a company and you see all this debt on the balance sheet, it makes it look like the company might be over leveraged and makes it harder to provide additional leverage or additional debt to the company. So we want to be able to help the company sort of unlock capital sources. So we come in on the equity level. So it shows up as equity on the balance sheet. So from a traditional lender who's looking at the balance sheet of the company, it looks much stronger. So debt has mandatory interest payments. We do not. We're actually flexible. We have something that's called PIK, which is payment in kind, which allows you to capitalize those dividend payments. So basically rolls right into the investment. Debt is subject to default provisions. Preferred equity is not. So typical debt structures like you have a DSCR, debt service coverage ratio. Preferred equity doesn't have that. For the way we're structuring it, there's quarterly dividends. We have it very flexible so that if you're relying on a big developer fee that's coming in and it's kind of lumpy, we allow for that lumpiness of payment as well. That's the reason why we structure it as preferred. We can go to the next slide. Okay, so again, this goes over some of the project just goals, which we've talked about, so we can go to the next slide. And so here, this is sort of an initial overview of what we're focused on. So our investment size is about 2 to 6 million within the company. Our target market is about developers that have about 1,000 units of multifamily within their portfolio. We've made exceptions to that. We've made exceptions down to the 200, 300 level. Some developers have much more than 1,000 units in our portfolio, but generally we're at that 1,000 unit count. And our hold period is about 6 to 8 years. And again, it's a preferred dividend structure. So it has some flexibility in repayment. Next slide. So I wanted to just kind of break down how this looks functionally on the balance sheet. So here are some basic numbers here. We're going to put in about $2.5 million in preferred equity into the company. They're going to be used for two main resources. One is a liquidity reserve of $750, and the other one is pre-development expenses for about $1.75 million. Next slide. And as you can see here, from like year 0 to year 1, inclusive of some losses, about 401,000 sort of in year 1, you can see how this enhances the balance sheet, right? Our cash is immediately seen in liquidity, in cash and marketable. The PP&E is effectively the use of the 1.75 for pre-dev expenses. And then the equity provision here, the 2.5 million. Without the equity, without the preferred equity, the debt would look closer to 10 million, or I'm sorry, 12 million. And our equity provision here would be closer to about 531,000. So it clearly shifts the balance sheet and makes it look much stronger. But the whole point of this is to unlock growth. So the next slide will show you how we're looking at it from a growth perspective. So the way we get repaid is we're looking at, if you can go to the next slide, Maggie. The way we're looking at this, we are looking at it from a growth perspective. So we will work with the developer and look at a 5-year, 6-year projection to try to see, where's that growth coming from? What projects are in pipeline? How can our capital help to facilitate some of those projects? And what does that look like from an income statement moving forward? And so we try to chart and project that growth with you, and try to see how that looks relative to our initial investment. So that's the presentation. I'll wait to the end for any questions.
Awesome. Thank you. Thank you. Thank you. All right, Mike, we're going to have you up next. And just to confirm, y'all can see the slides, right? Yeah. Okay.
Yeah, thanks.
Awesome. Hold on. Give me 1 second. I'm
Okay.
I'm not the best at Zoom, but we're going to get here. So give me a second. I'm trying to give you control. Okay. And then,
or you can just switch slides for me if it's just easier.
I almost got it. Give me 1 second. All right, bet. Now you should be able to do it. You good, Mike?
Yeah, that seemed to work. Thank you. Again, Mike Wyden with Blue Vista. Just real quick overview. I'll try to be efficient here. Blue Vista is a 20-year-old real estate investment management firm based out of Chicago. We have institutional equity and debt platforms. Institutional equity meaning our equity comes from funds from larger institutions, life companies, pension funds, and so on. We are focused on middle market equity investment in boots on the ground operators nationally. That's kind of our core business on the equity side, which is mostly what we're focused on here. And then we also invest directly. So our middle market equity platform is investing alongside operators in majority positions typically. We do have a couple direct investment vehicles in student housing and also core plus strategies in select markets. And then while we're here, the Accelerator Fund, which is basically a offshoot of our middle market equity platform, investing alongside operators. So went to the next one. Perfect. So, oh, no, back one. There we go. Okay, so fund objectives for the Accelerator Fund. This was started by one of the co-founders of Blue Vista, Robert Byron, in 2021. And it was really catalyzed by George Floyd and the BLM movement. We are institutional equity. Emerging manager programs are kind of a part and a step into institutional equity. And Robert visited a lot, or he's been to a lot of these conferences for emerging manager programs, sees a lot of talent in the room, and just very few, if anyone, gets selected. A lot of them already have big track records. So he kind of wanted to pair that with a diversity aspect to be able to offer early shots, because your first shot at getting institutional equity is extremely difficult. So he wanted to offer early shots to the folks that maybe don't have all the components and pieces put together, but have the talent and the capabilities, and give them an early shot with our capital. And instead of just trying to do more with, diverse groups, he decided we need to put our money where our mouth is, raise separate funds to invest in diverse operators, with the goal to bring more diversity into the institutional investment environment. And the way to do that would be to help them build track records. These groups build track records through programmatic investment, through ventures, in which they should be able to gain credibility to access more institutional capital. Going to the fund partnership dynamics, just a couple, this is in our flyer as well, so hopefully this stuff gets distributed. Again, you can reach out to myself or Dwight directly on any of this stuff or interest. But again, women and or minority owned operators are the focus. Well, I know part of the group here is focused on investing in neighborhoods and communities and all that stuff. We love it. That's wonderful. But our mandate really is the operator, the diversity of the operator. So let's see, we're doing a little smaller deal size in this, kind of as a step up entree into our traditional platform. And that's what we, another route, which hopefully we would be able to work with operators a few times, get to know them, build a relationship, and then have them kind of graduate up into our traditional funds and continue to work together. We are working on various asset types. But the predominant share of what comes in is multifamily. So we certainly have a focus there. Value add strategies over a shorter term hold period. We got to exit at the end. And, I know this is a little bit development focused, the room here, but we're not doing new construction in this first fund. So we're really looking for buy something existing, create the value, and exit. But hopefully in the future, we'll be able to do some new construction there. So to date, we've backed 4 sponsors that we're very proud of, and 3 of those have been multifamily focused sponsors, and then 1 industrial. Going to the next slide. There we go. Sponsor benefits. So these are just some of the things that we're kind of doing differently than traditional institutional equity might do. Aside from the smaller deal size and the earlier shots with the sponsors, we're providing outsized equity on these deals. Typically, our world is providing 80% of the equity, 90% of the equity required in a deal. We're really starting with our best terms at 95% of the equity, and even going up from there to remedy the needs of our sponsors. We're also very dedicated to coaching and mentorship. We've created materials for guidance and insight. And really the whole idea here is to also bring more transparency into the institutional world and institutional equity, because it's not transparent. If you haven't experienced it or been in it before, you just don't know what you don't know. And unfortunately, when you approach this type of equity, it's very efficient and it's all about quick no's and passes. And well, that's good for them. It doesn't help you out. So we've really dedicated ourselves to providing constructive feedback to every sponsor that comes to us with a business plan or a deal, and then to get deeper access and continue to do with that and grow with us and understand us and our capital and get to a deal faster. We can spend more time with our sponsors that go through our application process. And then also, there are the other benefits of working with a larger institution like Blue Vista, our resources that we can bring to the table and to the deal and kind of help you work through your, the aspects and challenges of your deal. We could jump to the next one here. Getting to yes. I put this slide in here that I kind of created based on feedback from Maggie that the room, it's a concern of theirs, getting the attention, being able to access capital as you meet it. And first off, I want to kind of make it understood that capital isn't a one size fits all. So it really benefits you to build relationships with multiple sources of capital that could be a potential fit for me. I know it can be hard to find. Groups like this are really important for that. This, as well as brokers out there, to get introduced. And then as you approach them, it's good to bring them deals that meet their general criteria. You need to understand and know your capital. If you're throwing stuff at them that really doesn't make any sense for them, they're going to look at you kind of like, you know nothing about us, and relationships, building that relationship is the most important part. We're not a transactional company. We really work off of relationships. Next kind of bullet here is about differentiating yourself. The point I want to make around this is that, capital partners, especially for younger, less experienced groups, they want focus and expertise. So if your strategy is too broad with regard to location, product type, value add, in our eyes, it's less likely that you'll be able to stand out, and more likely that you could make mistakes because it's just hard to be an expert in everything. Deliverables, it's very important in our process, in our application process, and with candidacy, we really kind of dive deep into these details and give suggestions and show you kind of how we might want to see stuff. Because really, at the end of the day, you're competing for time and attention. So you want to stand out with the work that you deliver to capital sources and ultimately, anticipate the questions, point out the risks and how you're going to mitigate them, really, and put everything together, a capital source might need. So you're not creating extra work for them because they're really focused on their time and getting to close deals. And if they feel like it's going to be a lot of work and they don't know what the outcome might be, quick no's and passes can come very easily. And then also kind of having that investment, showing, equity, how the investment is going to go beyond the acquisition, how you will execute. Showing them a deal that just kind of pencils is great, but they want to know that you're going to be able to bring it all the way through, through the hold period. And then the last bullet there is about mentorship. For younger groups, less experienced groups, I think it's really important to have mentorship for more experienced groups, possibly partnerships, even if it gives up a little bit of your deal, and will bring credibility as you're talking to capital and open you up to their relationships. So I always think it's just a good thing to entertain. Going to the next slide are the case studies. So I want to point out, 2 deals for now that we did that are both multifamily deals. One was in Atlanta. This one, well, we're all about track records and everything. We took a shot with a talented young group that had never done a deal on their own before, but the sponsors had really great experience working for institutional tier companies and went out on their own, and we backed them on their first acquisition, which is otherwise, again, a very scary thing to do. They do have local presence, which was of interest to us. And this deal had a great story. It was off market. It fell out of a portfolio as kind of the market got rocky. And some of the features of where we were able to help here, we came in with 97.5% of the equity requirement in this deal, which is kind of unheard of for most institutional capital because, which we're very happy to do so on a needs basis. We brought in a banking relationship to finance the deal when there weren't other options at that point. And then another interesting aspect was, bringing in our master policy for insurance. We had, there's always that uh-oh moment in a deal. And in this one, a couple weeks before closing, pipes burst at the property. The seller didn't tell us. All of a sudden, our insurance carrier, which is the existing insurance carrier, tripled our rates right before closing, which was not fun. And on paper, kills the deal. Deal needs to underwrite all the way through. And luckily, after going to market and finding no takers, we brought our master policy in. We brought the premiums all the way back down and closed the deal. And one more aspect on this one. It's really cool that at the end of the day, after us putting our faith in the sponsor and investing in them, because we were willing to do that, the sponsor was actually able to procure some OpCo investment from another institution within a year after us making our investment. The next slide is a deal we did in Johnson City, Tennessee. Not a huge market in Tennessee, but we dug in and found that it was really compelling. Our sponsor had a bit of a track record, not big enough to necessarily attract institutions, but they had a track record and they had a few deals existing in this market, even though they did not have local presence. So it wasn't as scary to go in because there was a little proof there. And then, they have a unique strategy in buying deals at the end of LIHTC restrictions. And, we dug into this market and it was really compelling. We got in there and realized that the comps all had waiting lists for tenancy, which showed really strong demand. And then, since then, we've done a second deal in this market with the sponsor and we're under contract on a third. So I'll leave it at that. And again, invite, anyone who's interested to reach out directly to Dwight or I afterwards with our materials and so on to move forward. Thank you.
Sorry about that. Thanks, Mike. Appreciate it. Took me a second to come off of mute, but I appreciate the presentation. And Andrea, we're going to turn it over to you.
Here, I don't think so.
Here, I'll click it for you.
Yeah, so very quickly, MSquared is a women-owned impact real estate platform. We have two sides of our business: an investment management side and also a development side, where I would describe ourselves as emerging developers also. We're focused on creating mixed income, mixed use projects that drive strong risk-adjusted returns and promote inclusive and sustainable neighborhoods. And so for us, from an impact perspective, we're really focused on three main areas. First and foremost is affordability, second, diversity, and third is sustainability, which is really about sort of transit-oriented locations and incorporating as much as we can from a sustainable design perspective. You can go to the next slide, Maggie. Thanks. So these headlines, I'm sure everybody's familiar with this, but from sort of affordability to diversity to the climate crisis, we think that there needs to be a new approach in how we're developing buildings and how we're developing housing in cities across the country. And that's really, and who is involved in that process. And that's really, what MSquared is all about. Next one. So as I said, we're focused on these kind of three impact areas, and where that comes from is sort of what's on this slide here. So we think that there's a supply and demand imbalance in the housing markets in the United States, and we think that in order to solve that, we have to build more housing. That is the only way that we're going to get out of this. And so right now, housing supply is inadequate, and it's also unaffordable. Too many people are rent burdened. I think now the statistic is more than half of renters are paying more than 30% of their pre-tax income on rent. And of course, that leaves households with much less money to spend on all of their other needs like food and healthcare, transit, etc. We also think that the traditional approach to building housing is segregated and segregates family on the basis of income, which often means also on the basis of race. And we want to try to do something in a different way. As all of you well know, we wouldn't be here if this wasn't true. There are massive gender and racial inequities across real estate. So the numbers there are pretty stark in terms of just who is funding real estate, who owns real estate, who's building real estate. You see so few sort of firms at the top that are led by women or people of color. And finally, our current infrastructure is not good for the environment, to say the least. So the solution, if we can go to the next one, Maggie, the opportunity is sort of like what we think is a new approach to doing this with a different way and with different people involved. And so MSquared is focused on developing new housing that is mixed income, so market rate alongside affordable, as opposed to either affordable over here and market rate over here, and the two don't mix. We think that's a more equitable way of building housing, and will lead to better outcomes for the families involved, as well as for the world, society at large. We try to include as many non-residential uses as we can in the projects where we're involved. We really look to try to target our capital to diverse-led development teams, so women and people of color, and we've been pretty successful at that. We'd like to be more successful. So glad to have the opportunity to meet more folks that fit that bill. And lastly, we really focus on, as I said, transit-oriented development, maximizing residential density in the neighborhoods where we're building, and incorporating as much as we can the energy efficiency side of the equation. Next slide. So I thought it'd be helpful just to walk through kind of what, as some of the others on the panel have done, what do we look for when we have developers come to us with an opportunity? We can invest across the capital stack, so we can be GP equity, we can be LP equity, we can be preferred equity, and in the case of us, we're investing in the project, so not investing in the operating company, but in the actual project that you're trying to develop. Size can range from 2 to 25 million. We're looking for returns in sort of the mid-teens area, and we have an investment horizon, because of the structure of our money, that's about 5 years. It can be a little longer, a little shorter, but we have to get out in about, call it 5 to 7 years. From the project standpoint, again, we have a few projects where they're acquisition, but by and large, we're doing development. So construction of new housing, it could be adaptive reuse of an existing building, but we have to be adding supply into the marketplace. That's part of what our whole thesis is about. And it needs to have an affordable component to it. So we need market rate alongside affordable housing units, a focus on women and minority-led teams. And then in terms of sort of what we look for, and how do you, this kind of goes back to what Michael was saying a little bit about how do you get to yes, and how do you get over that hurdle? Our initial diligence, and obviously we dive in deeper, but initial diligence, we want to know kind of the basics of your project. And this is, again, like back to fitting what we do. What's your percent of affordability? At what levels of area median income will you be offering those affordable units? But if you send us a project that's 50 units of market rate housing, that does not fit with what we do. So we're just going to say, no, that's not something we do. So again, sort of aligning with what our objectives are with what your objectives are, of course. Financial overview, so sources and uses and the status of other capital commitments, like secured debt. What do your projections look like? And I think, generally speaking, like we're of course going to do our own underwriting on all of these deals when we get them. And we'll probably have a more conservative approach than most of the developers when they send us deals. And that's okay, but we want to make sure that you're sort of grounded in some level of reality, even if it's a little bit of aspirational reality, and that's okay. But it can't be like, you're saying you're going to get rents on your one bedrooms that are $10,000 a unit when the current market is $2,000 a unit, right? So making sure that you're, kind of justifying how you're getting to the numbers that you're getting to. Development team background and track record, status of the site, where does it sit in terms of, do you have site control, do you have entitlements, and then what's the general kind of timeline that you're looking for in terms of closing on this money. I will say, with respect to development team background and track record, we don't typically invest alongside partners that have never done anything. Given the size of our investments, I'd say most of the projects that we're doing are 50 units plus. So if we don't look to necessarily have partners that have done 100 projects of 50 units plus, but we also I think would be a little bit hesitant to invest alongside a partner where, you know, they've had a couple of projects at, you know, 3 units or 5 units or something like that. We need it to be somewhere in that ballpark. And I think we try to be, you know, I think a little flexible in terms of where that track record comes from. So if you were somebody at another firm and then you started your own firm, and you have a track record from that other firm, we will certainly look at that track record from the other firm. It doesn't have to be all while you were, you know, an independent entity, and the track record only coming from your own firm. Next slide. Thanks, Maggie. So this is an example of a project we developed, or invested in rather, in Dallas, Texas. It's actually in lease up right now. This is with a woman developer who very much fits that description that I just laid out before, where she was with a big developer and she broke off on her own. She had done a couple projects on her own, though no housing projects on her own, and came to us with this site and said, I want to develop housing at this site, and will you guys invest in me? And so we're LP equity in this project. We typically will be anywhere from, you know, 85 to 95% of the total equity in any given deal, just depending on what that sponsor, you know, can do and what makes sense for the deal. In this project, it's about 50% market rate and 50% affordable. They went through a structure in Texas, which some of you may be familiar with, which is the PFC, Public Facilities Corporation. So in exchange for making those units affordable, the project benefits from a 100% tax exemption. And that's over about a 75-year period, I believe. And it's in this little neighborhood in Texas that is really blossoming and has experienced some pretty strong rent growth. So we're excited about kind of preserving some level of affordability in that neighborhood. This particular project is a fairly straightforward financing. Some projects are much more complicated, where they're trying to get various subsidies from a municipality or some other, you know, sort of tax increment financing, whatever it may be. Sometimes there's low-income housing tax credits involved. Sometimes there's historical tax credits if they're doing a, you know, adaptive reuse of an old building. It really varies, and I think one of the things that we like to do is really work with our partners. So we, you know, really try to help our partners go through that financing process and really think creatively about how you can finance the project, what tools are out there, what resources are out there, what programs exist in the area where you're developing, and really kind of be a partner to you throughout the project. So we're not just going to write a check and, you know, say goodbye. We're going to be there, you know, maybe too much there, from start to finish, both in the financing of it, and during construction and lease up. We have folks on our team here that sit through every, you know, owner, architect, contractor meeting once a week on all these projects, and they're listening in and they're, you know, providing insight. I think the fact that we are developers also helps with all of that. And so we really want to, you know, provide a value add experience to our partners when we go into these projects. But in this case, this was pretty straightforward. There was debt and there was equity. We were the bulk of the equity, and the developer went to a local bank and got a mini perm loan on the project, and it moved forward, and it's now leasing up, which is exciting. So it'll be one of our first projects to go through lease up. We can kind of skip this, but we have a lot of experience. We have people on our team that span both the nonprofit, public sector, private sector world. And so I think we can bring a lot of that to bear as we're working with our partners in these projects. Thanks, Maggie.
Awesome. Thank you. Well, thank you to all of our presenters. We really appreciate you all. So we're going to open it up for some questions. I'm going to ask that if you have a question, if you can put it in the chat, or if you want to raise your hand, I will unmute you if you don't act crazy. No, I'm just playing. But so just as a recap, hopefully people kind of get the sense of all of the different opportunities for financing, a lot of that being, you know, we often see conversations around debt, but not necessarily around equity. And so us being able to see where equity can be placed, whether that's at the entity level, whether that is at the project level and you're doing new construction, or if it's in your value add acquisition strategy. All of our presenters here today were able to talk a little bit about that in the work that they're doing. And so, you know, I just really want to thank them for being able to share. Just so you do know, we will be able to send all of the the recording, the presentations, their contact information. You will have all of that in a follow-up email as well. So we got a few more minutes, just seeing if anyone has questions. If not, I have questions for sure. So anybody? And if not, we're going to start with, oh, okay, somebody on the phone. So I can't call your name. So go ahead and unmute and you go ahead and ask your question.
Go with
All
your
right.
question, Maggie.
No, who's the
All right,
305 number? Go ahead.
Yeah, can you hear me?
I can.
All right, perfect. So look, joined this meeting because I had a buddy of mine, a friend of mine told me go ahead and take a look at this and how to go about getting capital. But I'm just gonna throw this out there. Well, there's a company called Putats that pretty much does the same thing with, what we're trying to do here. I think we need to start looking at this from a digital approach as well. But that's all I really wanted to throw out there. Where I think we're chasing funding in a very archaic way. There's decentralized financing left and right where we can literally come with our vision and they just fund. But
Okay,
that was the
well,
question I had. I wanted to get you, I guess, the rest of the team's input on what do you guys think, and gals?
So I'll just hop in and then I'll ask a question. Thank you for your comment. No one's going to fund just a vision, right? I think everyone has shared on here today that there's context for when they decide to fund. And so I think hopefully as we share out with the presentations that you'll see what some of those different offerings are. But I think today, the point of today's conversation was to be able to say, what are some additional opportunities that focus on people of color, women, folks working in underserved areas, all these demographics that are often overlooked, and look to find partners in that space. But I see, Dwight, you came off mute, so I'm gonna let you chat if you want to say anything.
Yeah, sure. I just have 30 seconds to respond to that. So I don't have a recommendation for or against using sort of that fractional sort of equity approach. The way I would think about it, though, is you've got a toolbox, and depending on whatever the execution is, development, value add acquisition, something smaller, something bigger, something that's more programmatic, where you're looking to deploy 100 million over the next 6 months or 2 years or 10 million. I think you would size and pick whatever your equity solution is based on probably the strategy. So I would say we, like a Blue Vista private equity company, we could coexist, and you would call on us when the strategy was appropriate. And it may never be appropriate, but there may be times where you do want to partner with institutional equity because it makes sense for the execution, the business, and you deem it a good partner, for whatever the strategy is, et cetera. So I'd say we could coexist with that. I don't think we would be in place of it or compete with it, per se.
Jarrell, Jarrell, you want to say something? You came off mute, so.
I did. The P2P space is fairly new. And like Dwight, I don't have an opinion one way or the other. I know they exist. That's about as much as I can tell you. I will say there is a continuum of financing, which Dwight was talking about, and I think it's important to understand that some lenders or some finance providers are good for startup. Some are better for larger transactions, and as you go across that continuum, you want to make sure that you're building your relationships across the line. That's all I had to say.
Awesome, thank you. So we only have 2 or 3 minutes left because it was such great presentation. So I'll ask this question and then I will have each of y'all just share out any closing thoughts and then we'll be out of here. So if there's a myth around equity financing, like I mean, there are myths, right? But what would you say are misconceptions that you are working to debunk or you want others on this call to try to think about as they are looking to access capital for their projects? And as you answer that question, if you have any closing remarks, we'd appreciate it.
First for me, I think the Shark Tank is a great show, but it also doesn't adequately reflect all the equity providers in the market. We're certainly not a Shark Tank type of firm. We're much more thoughtful and generative about our approach. And so I think that's one misconception, is that all equity providers are sharks in the Shark Tank, and that's not necessarily the case. From a closing remark, I would say that I think that from a solution that we're trying to provide in market, our solution is, and our approach is to try to be patient capital to allow businesses to grow. We are looking at other ways that we can be of assistance in sort of more startup or emerging type companies. But by and large, our approach is largely to help the community and to help developers grow their book of business.
Awesome, thank you.
So you sort of stole my comment there. Was gonna say literally the same thing, which is that, I don't think it has to be like, you look at your equity partner as like they're just trying to get me for everything I'm worth here, right? And it's this, zero-sum game where it's either them or me that's going to benefit in this scenario, I think. And we really look to try to partner with our sponsors and our developers as much as possible so that we both win at the end of the day. And I think that would be, probably my comment as a closing remark is, as you're going out and seeking funding, whether it's debt or equity, really making sure that you have the right partner and that your goals are aligned. In our case, we are very mission focused, so we look for developers who are also mission focused. Right? If your goal is, I want to build the most luxurious, condo complex that there is, like, we're not the right partner for you, but there is a right partner for you out there. So really making sure that you're aligned with your partners.
Awesome, thank you. Mike, Dwight, any last words?
I'll leave it to Mike.
Sure. No, again, I think the getting to yes section, answered some of that for me, and just building the relationships and exploring multiple sources of capital, because it's not a one size fits all, and even less so than debt, is for most cases. I'd say I would leave the group with hopefully you have our information and you can reach out to us directly if you feel like we're a good fit for you, or other folks, or you just want to hear more about us. We have materials built off of the conversations we've had to provide more transparency and guidance into our world. So we're happy to share those things and teach everybody, even if, to an extent, even if we can't provide them the capital. So don't hesitate or be shy for a conversation, or just to ask for our materials.
Awesome. Thanks, Mike. And as we close out, I just want to reiterate, we will be sharing out all of this information, sharing out their contact information. There's no way for us to be a connection point for each of you all. So please, please, please reach out to them if you have questions or are interested. People have money. They want it to hit the street, but it needs to hit the street in the right deals. And so they want to be partners in helping all of us do that, which was the purpose of the call. And so I also want to thank AAREP and BCREN for their partnership, for getting the word out, because again, the more people who know about this work, the more deals we can get done and see things happen in our community. So we are at time. So I'll just thank everybody. See y'all. Have a good one. Appreciate the time. Bye.
Thank you.
Bye-bye. Thank you.
Thanks, Maggie. Thanks, team. Thanks, everyone.
Nice to meet you.